Hi everyone, welcome back to another episode of Providend's Money Wisdom Podcast. I'm your host, Isaac, client advisor at Providend. Joining me today is Christopher Tan, founder and CEO of Providend. Hi Chris, great to have you back.
Hey, hi Isaac, good to be back, man.
Yeah, so today's episode we'll be talking about Chris's latest BT article titled What to Do with Your CPF Funds After the Special Account Closure. So Chris, as we all know, CPF is a very integral part of a lot of Singaporeans and CPF members' retirement in Singapore. And with the recent policy change, it created quite a stir among some communities. So I think it's very timely that you have written this article for the Business Times. So maybe you can begin with the reason why you wrote this article.
Yeah, I think since the announcement of the special account closure, I think since February last year, when then Finance Minister Lawrence Wong, now of course our Prime Minister Lawrence Wong, announced that we're going to close the special account. Yes, people are upset. Some people are upset. They felt that they have no chance now to earn that 4% after 55 years old in their special account. But I noticed a lot of financial institutions and the representatives coming out, to tell people and encourage people now to invest their money from the OA, right? And in the recent days, in fact, I've seen more and more of that, especially on my Facebook, a lot of social media. And well, honestly, Isaac, I don't really like the tone of it, because it seems to be encouraging people to quickly take out their money from the OA. It's like telling people, look, now you cannot get your 4% anymore from a special account. Why do you want to leave it in the OA, for at 2.5% in your CPF? I've got products that can allow you to get much higher than the 2.5. I can give you the products that can even give you more than 4%. I'm really not comfortable. Because I'm not sure whether it is the right thing to do. And if we take away all the emotions and all that and really sit down and think about what the original intention of our CPF monies are for, I'm not sure whether we should really invest it. So I felt that there is a need to, again, provide some clarity. Hopefully the article reached out to a lot of people. And before they take the money out and invest, I hope they can consider some of the points that I put forward, because I really hope that they are careful. It's after all their hard-earned money, and for some people, it's probably the bulk of their pension money. Yeah, so that's really the reason why I wrote the article.
Right, I also see a lot of, like you mentioned, a lot of representatives taking this as an opportunity, to have close new business, right, and a bit of fear-mongering as well.
Yeah, again, we just want to be clear that we are not against people talking about it. Yeah, but we just want to provide that clarity so that before they make that move, they consider some of the points that we put out on the article.
Right. Okay, so let's expand on one of the points that you talked about, which is the original intent of the CPF Special Account. Could you share what this intent was or is, and why was the CPF account closed for members aged 55 and above moving forward?
Yeah. Okay, the first part is easy. The second part is going to be a very long answer, right? And stop me anytime you think that I'm just rattling on and on. Well, the original purpose of the special account is that it is supposed to help accumulators, people who are not retired, accumulate their retirement sum, right? And that's why 4%, or rather for the special account, you are getting at least 4%. Right, and after 55, the monies that are accumulated in the special account will be transferred now to the RA to subsequently participate in CPF LIFE or drawdown. So if I may use financial instrument as an analogy, the special account, it's an instrument that allows CPF members to accumulate very safely and very decent interest rate, so that when they reach their retirement, it gets transferred to another instrument for them to draw down, right? So that's the purpose of the special account. Now, why did the government decide to close SA for those who turn 55 and above? Okay, this one is the one that is a long answer. I think I have to start first by talking about SA shielding. You remember SA shielding, right? I mean, now people don't talk about it anymore. But SA shielding was very popular before the closure of special account. So SA shielding is this, right? So before the age of 55 years old, if you didn't do anything at all with your special account, at 55 years old, CPF board will go to your SA first to take a sum of money to put into RA to form the full retirement sum. So if I use this year as an example, the full retirement sum will be 213,000. Now, if you don't have enough in your SA to form the 213,000, CPF board will take everything from your special account first, and then they will take the remaining of the 213,000 from the ordinary account, transfer it to RA to form the full retirement sum. After 55 years old, whatever that's left in your OA and SA, you got full liquidity, you can take out anytime.
And the sequence of which account they take from is important.
Yes. But based on the example that I've given just now, right, for most people, your SA will be either zero or very little. Yeah, you got still some cash left in your OA. So this whole idea of SA came about to try and have as much money in your SA as possible after 55. Right, so the way to do it is this. Just before you turn 55 years old, you invest your special account, keeping 40,000 because the first 40,000 of the special account you cannot be invested. Right, so if I use an example of 200,000, 40,000 cannot be invested, you invest 160,000 out. Right, and if you have got monies in the OA, the first 20,000 you cannot invest. You can invest anything above 20,000 in your OA. So you invest it in very short-term, very safe instrument. It could be a T-bill, it could be a money market fund. Okay, and then you wait for your birthday to happen. On your birthday, here comes CPF board. They're going to do the same. They're going to go to a special account and take the money to form the 213,000, right? They can't find. You're just left with 40,000. So they transfer 40,000. Now they're going to go to OA and take the remaining of the 213,000. Now they can only find 20,000, so they take 20,000. So after 55 years old, your RA is now 60,000. Your OA and SA zeroize, okay? And after your birthday, you can use cash, if you have cash in the bank, to top up your RA up to 230,000, right? So you top up the difference between 213,000 and the 60,000 in your RA.
So essentially, you're using a lower yielding asset like cash to top up your RA rather than SA or OA to top up
Precisely.
your RA.
Yeah, thanks for explaining that. And then after all that, you sell away all your investments. So 160,000 goes back to SA, and whatever that you have invested using your OA goes back to OA. And after 55, you have got a very high interest account like SA at 4% with full liquidity that you can take out any time that you want. You can draw out every day if you want it at 4%. But herein lies the problem. We all know that if you want liquidity, you cannot expect high interest rates, right? But SA has got pretty high interest rate at 4%, guaranteed capital, so say, but still full liquidity after 55. There is a misalignment of interest rates to the CPF savings. So the government decided that no, they want to. The primary reason of why they want to close SA after 55 is really to align CPF interest rate to the various savings account. Why is this important? Okay, so here comes the final part that I need to explain, which I didn't write in the article. Right, so now it's not exactly done that way. I'm not privy to how GIC manages our CPF monies. But if I think like a fund manager, Isaac, and you understand this fully well, right? You are a client advisor, you understand this fully well. So today, if I'm given a mandate to give a guaranteed 4% interest rate, or 4% return, if I have to account for expenses, I probably need to manage it a bit higher. So let's say I need to give a return of 5% every year, right? On average, the annualized return of 5% every year. And you know that to get 5% annualized return a year, no matter what, the money has to be invested into higher risk instruments like equities. And if you invest in equities, there'll be volatility on a year-to-year basis, right? And you have to accept that you cannot draw down anytime you want, because if you draw down at the wrong time, you will lose money. It's going to affect the performance, right?
Yeah, you need a certain time horizon.
Yeah. Right? But here comes the problem, right? So I've been given a mandate to manage 5%, but yet at the same time, I must allow investor to draw anytime they want without losing money. And if I have been given a mandate, then perhaps I would have no choice but to set aside some cash to prepare for that unexpected withdrawals from members, investors, anytime they want. And if I have to set aside cash, there will be a cash drag. What that means is that the returns will be affected, will be muted, or in order to still get a 5%, I have to take more risk, right? All that just for that few people who has the ability to draw down anytime they want. And this is akin to what is happening when you do SA shielding. You have a minority of people who are CPF-Rich, right? Because only the CPF-Rich will have enough cash in the SA to do all this shielding, right? So you have a minority group of us who wants to draw out money from SA, still want 4% by any time. So because of that, if I'm the fund manager, will have to set aside some cash. Now, who is going to subsidize for that? Who is going to be disadvantaged? It will be the majority of the common man in the street who really, they don't have a lot of monies in SA, right? They have to bear either the higher risk of the fund or they have to accept a muted returns. Right, and as the whole SA shielding movement got stronger and stronger and stronger, more and more people may do that. That's going to affect the fund. The common man in the street is going to be affected. And if you think about it, it's not really fair, especially so when the purpose of the CPF system is not to serve the rich. It is really to provide a very basic retirement for the CPF members. The majority of them are fellow Singaporeans, right? And so if anyone was to complain, it'd be me, because Isaac, I'm turning 55 this year. I just really missed the boat. And I should be the one like, what? I waited so long for this opportunity to do this shielding, and I've been explaining to people how to do it, and all that. Just when my time comes, I cannot do it anymore. I should be angry, but I guess I cannot be, right? Because for those of us who are CPF-Rich, it also means, and of course I'm assuming, and if you're listening to this, forgive me, my assumption is wrong, we should be in a better position to plan for our retirement using other ways. But we should consider those people who are not as financially able as us. They should not be disadvantaged. Yeah, so that's, I think, I'm not a government, but this is why I think there is a need to close the special account. I think it's the right thing to do.
Yeah, CPF, in terms of CPF, it really helps the common man a lot more. If we look at the proportion of their retirement income, CPF LIFE, and or rather the balance that the interest that they earn from CPF is going to make up a larger portion of their retirement income as compared to someone who is rich, who has that kind of income that allows them to have this sort of accesses in SA. So I agree with you in terms of at the end of the day, it's about sustainability of this scheme, right?
Yeah, and it's for the betterment of everyone. And I've written many years before that the CPF system is a Singaporean help Singaporean scheme, right? Although yes, PR also participate in CPF, but like I said, majority of the members are fellow Singaporeans. It is really a Singaporean help Singaporean scheme. And I think for the benefit of the country, it is the only right thing to do.
Hi listener, we hope you are enjoying this episode and podcast series so far. At Providend, we have been sharing our thought leadership content through various mediums beyond just this podcast. If you're interested in knowing more, check out the link in the show note to subscribe to our newsletter today. Thank you, and let's get back to the episode. Okay, but maybe let's just dive deeper into the specific impact of this change for CPF members so that our listeners can have a better idea. So could you share, using an arbitrary number, right, of someone with, let's say, 200,000, special account savings, right? So with this CPF SA account closure, what's the specific impact to this group of people?
Yeah. So firstly, again, I want to emphasize that the impact really is on the minority who are CPF-Rich. I think anyone after 55 years old, if they still have 200,000 left in their CPF special account, you are considered a CPF-Rich person, right? So let's say you have 200,000 in your special account after 55 years old, which used to earn 4% at least per year, right? And let's say your intention is to draw down on this every month $3,000, and you do that, and you do that, you want to do that, mitigating the 3% inflation, right? Adjusting for 3% inflation. That 200,000 will last you about, I calculated it will last you about 5.7 years. So now no more. The 200,000 is now transferred to OA. The same 200,000 is earning 1.5% lesser. So the amount of money, if you still want to draw down $3,000 per month, adjusting for inflation of 3%, that amount of money will last you 5.5 years. So it's 0.2 years difference, right? I think for somebody who is CPF-Rich and probably cash, they will have some money. I think for 2 months of difference is not too big an impact. Now, of course, if you still want your money to last for 5.7 years, then you just draw $100 lesser a month, right? And again, this is my opinion and my assumption, right? That for people who are financially more able, I think $100 lesser a month should not impact them too much, lah. But I know, Isaac, somebody who's listening to this may disagree and say, hey, Isaac, who says I'm going to draw down? I want to save it. I want to keep it later on, and then, which I wrote in the article, right? That, I want to put in my SA, I want to grow it. Then at 65 years old, then I transfer to my RA. I want a larger drawdown, lah, and now I'm getting 1.5% lesser, right? Then if that's the case, then my suggestion is that maybe now you should transfer it straight into your RA to earn at least 4%. And of course, some may listen to this podcast and they start putting in the comment, and say, no, who says I want to do that? Actually, I want to keep it as a reserves for as long as I can, right? I don't want to touch this money, and it's 4%, Then yes, you can consider investing. You can build a diversified portfolio on your own or with your advisor, and you have the time horizon because you say you won't touch it. Then the chances of you getting a expected return of above 4% is there. You can then do it. So the options are still there. Honestly, there's some impact, but it should not impact too much.
Right. We'll talk more about the options later on in this podcast. But before we go there, I noticed in your article you made it a point. There's a whole section where you talked about essential versus discretionary expenses, right?
Yeah.
So of course, it's not. Intuitively, it doesn't really relate directly to the topic, but I see that you made it a point to allocate quite a substantial portion of your article to talk about this. So why is it important that we talk about the differences between essential and discretionary expenses?
Yeah, it's a good question. And the reason really is at Providend, we always say that our job is to give our clients the highest probability of success. That's our job. The highest probability of success is not measured by returns. We can't guarantee returns, right? The highest probability of success for our clients means that they have the money to live the life goals that they want to achieve when they need to achieve it. That is what we mean when we say the highest probability of success, or rather that's what we mean when we say success, right? And because of that, we need to be very specific. Right? And that is why in our retirement planning for our retirees, we are very intentional to try and know what are their essential expenses, or what we term as the Singaporean call it die must have expenses, and discretionary expenses, so that we can find the correct instruments to fund these expenses. For essential expenses, we must use instruments that cannot fail them. We cannot fail our clients, because if we fail them, then we are not giving them success, right? And to fund essential expenses, one of the instruments that we use would be annuities. And CPF Life is really the best annuity. And the article, I showed a table to demonstrate why CPF Life, in terms of payout per dollar premium, is the best annuity. That is why I broke it down into essential and discretionary, to build a case later on that, if your intention, right, is to use an annuity to fund your essential expenses, consider CPF Life. It's really the best at this moment. And if that's what you want, don't worry about the money in your OA now not getting 4% from your SA. You can now transfer it to your RA to get 4% at least. And then subsequently, you can participate in CPF LIFE to give you that lifelong income stream, because if your original intention was to fund your essential expenses, you got to do that anyway. Then why don't you transfer it now?
Right, and it's in line with, of course, the SA account closed, but of course they raised the enhanced retirement sum limit as well.
Yeah, precisely. And thanks for pointing that out as well, because I mean, for some people, they are like, do I really want to top up my RA to 426,000 this year? Right, and later we can talk about who should do that. But well, as a part of consideration, I wanted to show that CPF Life is a good instrument to use, and so that if you are able to, then you can consider topping it up to 426,000, which is currently the ERS, the Enhanced Retirement Sum.
Okay, so I think now, since topping up to RA is one of the options, right? But maybe you can share with our listeners, okay, if let's say that is something that they are considering, right? But what are the other options that CPF members have with regards to their savings in their ordinary account? Yeah,
so I'll keep this short because it's really in the article, so do go and read it. Now, what to do with your OA now after SA closes really depends on the original intention of your monies had SA was to be around. So if your original intention of your monies in SA is that you want to keep it there, get your 4%, and then at 65 years old, you consider whether you want to transfer that money into your RA up to the then prevailing enhanced retirement sum to have a higher CPF life payout. That is your intention, let's say. Then option number one, transfer your money from your OA now, because your money is no longer in SA. SA is closed already. Transfer your money in your OA now to RA. You get your 4% straight away, and then you can draw down. Intention number one. The second intention, or the original intention of your SA money, had it still been around, is, let's say you intend to keep it as reserves. You don't intend to use it. Well, as we mentioned before, then yes, you may want to keep a portion still with OA because it's 2.5, not bad. Or you can invest it in a diversified portfolio of equities and bonds. Because reserves, you don't intend to use it until much later, you can take some risk. But if your original intention of your monies in SA had been still around, is you need to draw down immediately for the next 10 years before your CPF life starts, right? Because at 55 years old, maybe you're not working anymore, you wanted to use it for the next 10 years before you start withdrawing down from your RA and CPF life, then you really should not be investing, because you are drawing down now and you cannot take volatility risk, right? 2.5% is, 1.5% lower than SA, but it's still not too bad. So you should not be investing. So these are the three options. There are also points of consideration that I lay down for you before you succumb to that temptation of taking the money and investing it somewhere else.
Just to recap, so it's either topping up your RA, investing it in a portfolio of maybe a mix of stocks and bonds, and of course, spending down on it. If you're in retirement and you want something that is liquid, you can just spend down on the OA account.
That's right.
I think before we move forward, I think I just want to also highlight that certain considerations, when it comes to topping up your RA, I think it's good to let our listeners know that this process is irreversible, right? So of course, before you do that, it's important to take note of your liquidity in terms of your, whether you need this money, because CPF Life pays out from 65 only. So maybe a period of time from 55 to 65, you don't want to quote unquote lock up your liquidity and find out that you've run out of money before CPF Life starts paying out, for example. Right. And of course, one of the options that you've given to our listeners is, of course, to invest their monies. In your article, you stated that even though this is a viable option, right, if there's a time horizon, but you mentioned that you're personally not very excited about it. And I want to take this opportunity to ask you why. I mean, if they have the time horizon, let's say in the article you cited minimally 8 years, for example, why are you not personally excited for people to potentially get higher returns with their OA savings by investing it?
Yeah, I guess for the clients that we see at Providend, I mean, we are in a way very privileged to serve clients who are more affluent, right? And they have a lot of assets, and they would have cash in their accounts that are yielding lower than the OA of 2.5%, right? And so if I'm looking at what they have and suggesting that they invest, I will first recommend them to use their cash to invest instead of OA 2.5. 2.5 forms a very good base of low risk but pretty decent return kind of account or instrument, right? I mean, if I've got an account that will give me 2.5 at least for the next 10, 15, 20 years guaranteed, right? Well, it's not bad and I don't want to touch it, right? I will touch my other cash that is giving me lower than 2.5%. But let's say the interest rate environment is such that it goes up and yields go up as well, just like what we have experienced for the past 3 years. Then okay, I will take my CPF. I will recommend my clients to take their CPF OA money and probably buy some T-bills. You get higher than 2.5, maybe you get 4%. When times are good, enjoy it. And then when the yields go down again, then put it back in the OA and get at least 2.5%. It's a very good base to start, right? So I'm not too excited about getting clients to use their OA to invest. But what about common man in the street, right? That they don't have cash. Do I really want to get them to use their OA to invest? And I said it when I wrote it that unless it's absolutely necessary. Absolutely necessary means that they have so little in the OA, and if they don't invest their OA and they don't have cash as well, it's going to be very hard for them to reach their retirement goals. And okay, right, I will do it. But otherwise, I mean, our experience, and even when I was in the CPF advisory panel between 2014 to 2016, what we have seen is that most Singaporeans are worse off when they invest their OA. They are actually better off to put their monies in the OA, right? So I'm worried for them because they might not have the investment experience, they might not have the investment knowledge, they may not get good advice, and they buy the wrong things, they lose money. They might as well just leave it in the OA and get 2.5%, right? So I that's why I said I'm not too excited. I'm not in a hurry. Of course, this is a podcast and we can only be very general. And if you're listening to this, you have your own similar situation. We always say in our podcast, this is not financial advice, right? Because everyone's situation is different. You should really speak to your trusted advisor. But I just really want to speak to you if you're listening to this, that I hope you don't just go out there and then say that, okay, I'm not getting 4% right now. Very, very angry. I'm not going to leave it in the... You don't allow me to get 4%, right? I am just going to take it out and invest it on my own. I make sure I get more than 4%. Before you do that, please consider some of the points that we put out here and on our articles, right? The 3 points you have considered, and then carefully consider whether should I do it or not. Don't rush. Last year when I was in China, I learned these 2 words in Chinese. And it's called 且慢. 且慢 in English, it's not the best translation. It's not a perfect translation. It is like pause. Take a pause, right? So before you rushed out there and start taking your monies from your OA and start investing it, 且慢, take a pause. Consider some of these points carefully. There's no need to hurry before you invest it, because this was the way I ended the article. It is, after all, your hard-earned money.
Yeah. Okay, so with that, let's end off this episode. Thank you so much again, Chris, for your time today and your insights. And to all our listeners, I hope you like this episode. So please follow our podcast and subscribe to our YouTube channel if you haven't done so already. Okay, so as always, thank you all for listening, and I'll see you all in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.